Many seniors are being misled about reverse mortgages, which are often seen as risky or a last resort. But what if the very tool you thought was a danger could actually be the key to a worry-free retirement? As a senior living specialist for over a decade, I've helped countless seniors in every financial situation you can think of. But they all have one thing in common. After understanding the product, almost all of them considered a reverse mortgage, and you should too. Now today, we're not just scratching the surface, we're going deep. Now you've heard the rumors, reverse mortgages can drain your equity, leave you without a home, or saddle your heirs with debt. But these fears aren't based in fact. In fact, most of them are fueled by complete misunderstanding. Therefore, for the rest of the video, we're tackling the 4 biggest myths head on, armed with nothing but the truth and real-world examples. Let's jump in. Myth number 1, the bank is going to take my house. Let's kick things off by tackling one of the biggest myths head on, the idea that getting a reverse mortgage means the bank takes your house. Now this couldn't be further from the truth, and here's why. Just like with a traditional mortgage, in a reverse mortgage, you hold the title to your home. A reverse mortgage is simply that, a mortgage. The bank does not, I repeat, does not take over ownership. You're essentially borrowing against the equity you built up in your home over the years. Here's how it works. You receive money from the lender, which is usually a bank, and this amount is based on the equity you have in your home. But here's the awesome part. There are no monthly payments required. Instead, the balance grows over time as interest is added to the loan amount. Now, just like a normal mortgage, the bank can foreclose if you don't meet the terms of the loan, but you always retain title to the house. So where does this myth come from? It has to come from somewhere, right? Historically, primarily in the 1970s and 80s, there were private reverse mortgage products where the lender did indeed require homeowners to transfer title to their house as part of the agreement. These were predatory loans that targeted and exploited seniors. These loans galvanized the fear and led to the widespread belief in the myth about the bank taking the house. Because back then, some of these lenders did take the house. But all of that changed for good back in 2014. You see, the Federal Housing Administration, FHA, sanctioned a program that ensures all reverse mortgages are now government-backed and insured. Now, even if the market completely crashed and you were totally underwater in your mortgage, the banks still can't take the house away. But what does happen if your loan balance is higher than your equity? That discussion leads us into myth number 2. The second myth is that the heirs will be left holding a bill when you pass away. Let's set the record straight. First, it's important to understand that the reverse mortgage is a non-recourse loan. This means that the loan is secured by the property itself, and when the borrower passes away or decides to sell the home, the loan needs to be repaid, just like any other loan. But here's the critical part. Remember when I said that FHA insured the loan? This means that the repayment amount can never exceed the home's market value. If it does, the Federal Housing Administration insurance kicks in and covers it. This ensures that your family is not financially burdened beyond the value of your home. But that almost never happens. In fact, the vast majority of the time, most of the equity in your house is still intact because your house goes up in value faster than you accrue interest to the loan balance. It's simple math. If your home is worth $500,000 and it's going up in value at 4% every year, at the end of year 1, your home would be worth $520,000. But here's the kicker. Even if your interest rate is high, let's say 7%, if you're gaining 7% interest on a loan balance of $250,000, which is about 50% of your house value, at the end of year 1, your loan balance would be about $267,500. Now, how did your equity change in this example? It went up. Your equity started at $250,500 minus $250,000, and at the end of the year 1, it's $252,500, which is just $520,000 minus $267,500. But what if the market doesn't go up? In fact, what if it crashes? You remember when I told you heirs would never be left holding a bill? Actually, it's much better than that. If the real estate market crashes and the loan balance exceeds the house value, through a program called Cash for Keys, heirs can receive up to $12,500, even with negative equity in the home. Now, with your worries eased about your heirs inheriting debt, let's shift to myth number 3. Number 3 is that reverse mortgages are a costly way to access your home equity. After debunking the first 2 myths, you might be thinking, this sounds too good to be true. But here's the reality. Reverse mortgages aren't too good to be true, but they are too good to be free. Now, just like every government-backed mortgage, you can expect to pay an origination fee, insurance premium, and closing costs. But unlike other government loans, your insurance premiums are buying you peace of mind as well as the lender. When you consider the upfront costs, it can sound pretty hefty, right? But hang on, think about what you're not paying every month. No monthly mortgage payments. Now just imagine what you could do with that extra cash every month. Suddenly, these costs don't look like fees. They look like freedom. Now stack that against a home equity line of credit or a second mortgage. Sure, they might seem cheaper at the closing table, but they demand regular payments with interest. If you're retired, that's a monthly strain on your budget that you don't need. But with the reverse mortgage, the interest rolls up, quietly accruing, not demanding a dime until you sell your home or the last borrower leaves it. If you're staying put for the foreseeable future, that's not just convenient, it's strategic. So is a reverse mortgage expensive? If you're simply glancing at the surface, maybe. But if you're planning long term, it's an investment that buys more than just time. It secures peace and preserves lifestyle without the immediate financial burden. Isn't that worth considering? But what if you don't want to stay in your current home? What if you have stairs, a big yard, and home maintenance that you just can't keep up with? Reverse mortgages are only meant for those that want to stay in their current homes, right? Let's debunk myth number 4. This myth is that you can only get a reverse mortgage on your current home. And this is maybe the biggest myth that keeps seniors from retiring safely and with more freedom. What if I told you that you can buy a new home with a reverse mortgage? Let's debunk this myth with a real-life story about some of my clients. It might just change the way you think about your next home purchase. Meet Steve and June, a couple who thought their dream of a safer, more accessible home was completely out of reach. Their old home was a 2-story house valued at $350,000. Now, it was fully paid off, but those stairs, they were becoming a daily hazard. Imagine facing the fear that your own home could be the place of a catastrophic potential fall. That was a daily reality for Steve and June. And what was even worse, prices for single-level homes were skyrocketing. On just their Social Security income, the numbers did not add up. They feared a mortgage was absolutely inevitable, and that was a financial strain that they just couldn't handle. But here's where their story starts to take a turn. Enter the reverse mortgage for purchase, a solution they hadn't even considered. They sold their old home and used $280,000 of the proceeds to help them buy a new one worth $420,000. The new home was all on one level with 0 steps, and it was in a 55 and older community where all their maintenance, snow removal, and landscaping were taken care of. Think about that. A perfect home, perfectly suited to their needs without the burden of monthly payments. And the really cool part, they even set aside some cash for renovations, all possible through a reverse mortgage. So how did this impact their lives? It gave them safety, comfort, peace of mind, all without draining their finances. Now, if you're sitting there thinking your options are limited, let Steve and June inspire you. Reverse mortgages aren't just about staying put, they're about moving forward to better living. So now that we've debunked the 4 biggest myths of reverse mortgages, what other questions do you have? Let me know in the comments. Thanks for watching, and I will see you on the next video.